Good afternoon. I do apologise. We did have some technical difficulties today. This is the slightly late Asian midday market watch from BizTech Asia. I'm Jeffery Halley, and today is the 5th of February. Our guest today is Vishnu Varathan, the Head of Economics and Strategy at Mizuho Bank in Singapore. Vishnu, welcome to the program.
Hi, Jeff. Thanks for having me on, and it's great to start the week with you.
As ever on our side as well. Let's just have a look at Asian stock markets. It's not a particularly great day around the region, with the exception being Japan. The Nikkei 225 is up 0.6% today, but Shanghai has fallen now nearly 2.4%. Hang Seng is down 0.3%, while the ASX 200 in Australia is down just a tad under 1%. The Kospi in South Korea is down 0.88%, while Singapore has slumped by 1.66%, with KL falling by 0.16%. Vishnu, what do you make of these moves today?
Well, I mean, it does look to some extent that Asia is not taking on US equity market optimism wholesale. It's being tempered by many factors and surely checked by pre-existing risks that have been accentuated. I mean, for one, whilst US equity markets were happy to run with the story that a strong jobs number means that it is US economic exceptionalism, great earnings, and so filtering down into equity market optimism, I think Asia took the other side of the coin, which is this is going to impede Fed cuts. And as you saw, USD yields went up, so higher US bond yields, a stronger dollar, all of that started weighing on Asian equities. And to add to that, you've got a slew of China risks, whether it's US-China tensions from Trump's headlines about tariffs, or it is the China banking, sell-off that hasn't been abated, and which hasn't abated despite Beijing saying that they will backstop. I think that highlights the extent of the confidence deficit, and that inevitably is also dragging on the rest of Asia. So Asia is on a very cautious note, and in particular, so long as they don't get something that's unequivocally good in terms of risk on trade, caution might be the order of the day. And the last factor here is, of course, ahead of the Chinese New Year holidays, markets might choose to be defensive and take risky bets off the table.
And we saw the PMIs, the Kaizen services PMIs missed slightly this morning, so yet another disappointing number. But also we saw Chinese officials over the weekend making more statements about promising to stabilise the mainland stock markets. But the problem, as ever, has been a complete lack of detail about how they're going to do that. I'm guessing that looking at the price action today, that is still undermining sentiment.
Yeah, I mean, I think markets are really trying to tease out the devil. And given, as you rightly pointed out, the conspicuous absence of details, that's really not working well for shoring up confidence in the market. I think markets are now in a mode where they're suggesting we'll believe it when we see it, and they're not sure what they're going to see. And so far, given the drip feed of stimulus over a long run, you juxtapose that against the fact that Chinese officials are quite wary of going overboard with stimulus lest they trigger financial stability risks, means that markets are circumspect and certainly doubtful about whether you would get that kind of Draghi style kind of anything it takes stimulus. And unfortunately, that something closer to that order might be exactly what markets are looking for.
Right. And also making the headlines today is an interview that Jerome Powell has done on 60 Minutes television. And in it, he appears to push back both on the timing and the trajectory of US rate cuts, coming after the huge non-farm payroll number that we saw out of the US on Friday. Where are you seeing the trajectory of monetary policy for the Federal Reserve at the moment?
I mean, you're right. I mean, I think Jerome Powell is in contrast to his December meeting, getting clearer that any rate cut is not going to be imminent, nor is it going to be unconditional. Given the really strong jobs number and the equity market rally in response, both of which suggest that the rate cuts must come much later rather than sooner, tells us that the Fed might in fact be validated on their point that any rate cuts would be after data assessment, and perhaps they don't have that many in the bag for this year, maybe 75 basis points as they indicated in December. And that means maybe Q3 is when they want to start, if they want to assess and pace it out. Our own view, which is a somewhat contrarian, is that the Fed would start by the middle of the year. And that's because they'll probably see economic weakness coming through quite abruptly in contrast to the data that they're seeing now. And in particular, from the household segment where the consumer's propensity to buy up goods starts to diminish a bit more markedly. And if we are right about that, then the Fed might start to get cold feet and move sooner. The other angle and the other dimension of risks that would be very hard to time or predict would be any other further seizing up of liquidity in the banking sector or any shocks in commercial real estate. But essentially, we have got enough left field risks such that that plotting a linear path based on current data would not be the wisest course of risk management.
And continuing on the United States, Donald Trump will not be far from the headlines in 2024. And he has allegedly been saying that he's looking at imposing a 60% tariff on Chinese goods, all Chinese goods, if he is elected in November. Now, my first thoughts are that won't be either good for inflation or future rate cuts into 2025. But my understanding is it's not a simple linear relationship between tariffs and inflation. I'm wondering if you could perhaps elucidate on that a bit.
Yeah, I mean, you make a good point because, you initially get the dollar getting a lot stronger in the initial risk of reaction. So that would absorb some of that price shocks from the imports channel. You would also have the issue of, just to some extent, you would also have the issue of transshipment, substitution, all of which would take some edge off inflation. But I think generally your thought is right. It is going to be very unhelpful for disinflation. It's going to disrupt that cost. It's going to add to policy complexity because the Fed would need to think about whether there would be second round effects from this in terms of driving inflation a lot higher, or it ends up being, ultimately disinflationary because it has a negative demand shock. So those factors would complicate issues a lot more. But I just want to make one last statement and say, although the impact on demand and exports for Asia is going to be a lot more pernicious for a start.
Right. Yes, I was pondering about the impact on Asia as well. It's no good news there. It's going to be a momentous year, 2024. Just briefly, what else are you looking at this week? We do have a couple of central bank rate decisions from the region, I know.
Yeah, this is a very, very busy week. We've got the RBA, we've got the Bank of Thailand, we've got the Philippine Central Bank. All of them are probably going to be on hold for various reasons, but not with much comfort, though. Right.
Okay. Well, in this Lunar New Year week, thank you so much for joining us today, Vishnu. It's always a pleasure having you with us.
Pleasure was mine, Jeff. Thanks for having me.
We've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank in Singapore. This is BizTech Asia's Midday Market Watch. Once again, apologies for the technical delays, which made it an almost midday market watch. I'm Jeffery Halley, and this video and podcast will be on our website, www.biztech.asia, our social media platforms, as well as our syndication partners, television stations, radio stations, and websites. Thanks for tuning in.